Today, we're basically cracking open a time capsule. It's a 45-year-old letter from Warren Buffett, written during a time of absolute economic chaos. But here's the crazy part. The advice inside holds a secret to protecting your wealth that feels like it could have been written this morning.
Now, to really get this, you have to transport yourself back in time. Imagine the mood. By the end of the 1970s, after a decade of just brutal economic pain, most people had completely, utterly given up on the stock market. Seriously, they thought it was a losing game. Totally over.
So let's start there. We're going to travel back to the crisis of 1979, a time when it honestly felt like the floor was falling out from under the entire economy. I mean, just look at this timeline. It was a relentless storm. It kicked off with the oil crisis in '73, which then morphed into this economic nightmare called stagflation. That's the toxic combo of high unemployment and high inflation. As if that wasn't enough, a second energy crisis hit. So by late '79, when Buffett is writing this letter, inflation was a jaw-dropping 14%. Every single dollar you had was literally melting away like an ice cube on the sidewalk. And right in the middle of all that panic, what does Buffett do? He offers this incredibly calm, almost chillingly rational observation. He's saying, hey, you know that business that looks amazing on paper, earning 20%? It could actually be making its owners poorer. This was a completely different way of seeing the problem. And here's what's so incredible. To make his point, Buffett doesn't brag about how smart he is. He starts with radical, brutal honesty. This letter isn't some victory lap. It's a masterclass in admitting your own failures. First up, he totally owns a huge business decision. He'd bought this textile company, Wombeck Mills, for what seemed like a total steal. But he admits, just flat out, it was a mistake. The business was just fundamentally broken. And then boom, right away, he pivots to an investment mistake. In a world with runaway inflation, he'd bought long-term bonds, locking himself into a fixed return while the value of the dollar was just collapsing around him. Again, just a clear, simple admission of error. But this is where the lesson gets really deep. He says the bigger mistake wasn't just buying the bonds. It was his failure to fix the error. He just held on instead of selling them, even if it meant taking a loss. And that's such a powerful lesson in intellectual honesty, right? It's not just about admitting you're wrong, it's about having the guts to actually do something about it. Okay, so these mistakes, combined with that brutal economic climate, led Buffett to create this incredibly powerful mental model he called the Investor's Misery Index. It's a super simple way to see the hidden damage inflation is doing to your money. And this is the central puzzle he lays out for everyone. It sounds impossible, doesn't it? If your investment is growing by 20% a year, you've got to be getting rich. But as Buffett is about to show us, this can be a really dangerous illusion. So here's how the math actually works, and it's deceptively simple. First, you start with that impressive 20% gain. Looks great. But then, step 2, the inflation monster comes along and eats 14% of it right away. So you're left with 6%. But here's the real trap. Step 3, the government taxes you on the entire 20% paper gain, not your real 6% gain. So pretty much all of that 6% you thought you had left gets completely wiped out by taxes. And this is the shocking result. After that double hit from inflation and taxes, your fantastic 20% return just vanishes into thin air. Your actual gain in purchasing power, your ability to buy more stuff next year than you can this year, is basically zero. You've been running as hard as you can just to stand perfectly still. So this brutal math, combined with his own painful mistake in the textile business, led Buffett to one of his most famous, most enduring principles: understanding the massive difference between a cheap price and a truly great business. He figured out that trying to fix a bad business, even one you bought for a quote-unquote bargain, is almost always a losing game. It is so much better to put your energy into buying a truly good business at a fair price than a lousy business at a wonderful price. And this slide just lays out the two paths perfectly. On one side, you have the bargain trap, a cheap business like his textile mill that's just a constant headache and earns terrible returns. But on the other side, you have what he calls an easy business. Yeah, it might cost more up front, but it just gushes cash effortlessly, almost like it can't help but make money. Okay, so when you put it all together, the brutal reality of inflation, the radical honesty about mistakes, and this intense focus on good businesses, you arrive at a single, incredibly powerful rule for investing. This is it. This is the golden rule from 1979. In a world where your money is constantly losing value, your best defense isn't a cheap stock. It's a high-quality business. A company that can earn huge returns on its capital without needing tons of new investment is basically an inflation-fighting machine.
And this is why this lesson from a nearly 50-year-old letter is so urgent right now. We all get fixated on the daily noise of a falling market, the red and green arrows. But Buffett is here to remind us that the true enemy, the silent killer, is the slow, relentless erosion of your purchasing power. So I'll leave you with the core question from that 1979 letter, because it's as relevant as ever. As you look at your own investments in today's economy, are you hunting for bargains or are you hunting for great businesses? Because as Buffett learned in the chaos of the 70s, they are very, very rarely the same thing.